Hey everyone. So, if you're selling stuff online in India, you've definitely come across that three-letter word that can cause a massive headache: GST, right? It feels super complicated, but honestly, it doesn't have to be. Over the next few minutes, we're going to break it all down step by step so you can handle it like a total pro. Let's dive in. You know that feeling, right? Your online store is finally live, the orders are starting to come in, and then bam, you're hit with this wall of tax rules and confusing acronyms. It seriously feels like you're trying to find your way through a maze blindfolded. But don't you worry, we're about to hand you a clear, simple map to get you through it with confidence. All right, so first things first, what's the very first hurdle you've got to jump? Well, this is one you have to deal with before you even make a single sale. And for online sellers, listen up because this is non-negotiable. It's all about getting registered. Okay, now this is probably the single biggest difference between selling online and having a physical shop. You see, your local corner store, they might not need to worry about GST until they hit a certain sales target, a few lakhs maybe. But for you, as an online seller, the rule is totally different. Your threshold is zero, from rupee 1. So why the tough rule? Well, the government needs a way to keep track of all those sales zipping across state lines on big platforms. It just means you have to be officially in the system right from the get-go. So the bottom line here is super simple. If you're selling on a platform like Amazon or Flipkart, you absolutely must have a GST registration from your very first sale. No exceptions. Now, you might have heard about this thing called the composition scheme. It's kind of like a simpler, easier tax plan. But here's the catch. It's not for people selling goods online. Nope. You have to go for the full, formal GST registration right from the start. Okay, so you're registered. Awesome. Now we get to the fun part, actually making sales. But what happens behind the scenes every time a customer clicks that buy button? Let's follow the money and the paperwork. You're going to see this acronym everywhere, TCS. It stands for Tax Collected at Source. Now, I know, it sounds a little intimidating, but it's really not. Think of it as a tiny tax deposit. The platform you're selling on, say Amazon or Flipkart, is required by law to collect 1% of your sale value. They don't get to keep it. They immediately turn around and pay it to the government for you. Let's walk through this. Say a customer buys something from you for 1 lakh rupees. The platform automatically takes out 1,000 rupees, that's the 1% TCS, and sends it straight to the government. So you get 99,000 in your account. But, and this is the most important part, that 1,000 rupees isn't gone forever. It's just sitting there in your government tax account like a credit, ready for you to use when it's time to pay your final tax bill. And what's the one piece of paper that holds this whole thing together? Your tax invoice. Seriously, this is the linchpin. It's the legal proof of the sale. Getting it perfect with your GST number, the right product codes, a clear tax breakdown, all of it is the foundation for making this whole process smooth and stress-free. Okay, up until now, we've only been talking about the tax you have to pay out. But now for the really good part, getting some of that money back in your pocket. Yup, you heard me. This is where you can actually make a big difference to your bottom line. And it's all thanks to a little something called Input Tax Credit, or ITC. ITC is an absolute game changer. Put simply, the government lets you claim back the GST you've already paid on your business expenses. We're talking about everything. Packaging materials, advertising you've paid for, maybe your office rent. Any GST you paid on those things can be used as a credit to reduce the GST you owe on your sales. It's amazing. Let me show you how it works with a quick example. Let's say, based on all your sales this month, you owe the government 20,000 rupees in GST. This is what we call your output GST liability. But during that same month, you also bought things for your business, right? Let's say you paid 5,000 rupees in GST on all that stuff. Well, that's your available input tax credit. So here's the magic. Instead of paying the full 20,000, you get to subtract that 5,000 rupee credit. The amount you actually have to pay the government is now only 15,000 rupees. That is 5,000 bucks that stays right in your business's bank account. It's a huge deal. But, and you absolutely have to listen to this part, there is one golden rule. You can only claim that ITC if your supplier did their job and filed their taxes correctly. Every purchase you make should automatically pop up in a government report called your GSTR-3B. Think of it as the official final statement of what you can claim. If a purchase isn't on that GSTR-2B report, you cannot claim the credit. I don't care if you have the paper invoice in your hand. If it's not in GSTR-2B, it doesn't count. That report is the single source of truth.
So yeah, ITC is incredibly powerful, but you've got to play by the rules. Getting it wrong can be really, really costly. So let's talk about some of the most common traps sellers fall into, and more importantly, how you can stay out of trouble.
The law is super clear about some big no-nos. These are called blocked credits, and they're mostly about personal stuff. You absolutely cannot claim ITC on the GST for your personal car, for food and drinks, or for that family vacation, even if you swipe the business card. It has to be a legitimate business expense, period. And believe me, the cost of making mistakes adds up scary fast. If you're late with a payment, you're looking at a steep 18% annual interest. And for other mistakes, the minimum penalty is 10,000 rupees. It can go way higher from there. So the message from the government is pretty clear. It really, really pays to get this stuff right. Okay, I know hearing about penalties can be a bit intimidating, but it doesn't have to be. Let's pull everything we've just talked about into a simple, straightforward checklist, something you can actually use every single month to stay on track. All right, here is your monthly game plan. First, just do a quick check to make sure your GST registration is active. It's simple, but so important. Second, check that TCS amount the platform took out and make sure it matches what you have in your books. Then, the big one. Go through your GSTR-3B report and match every single purchase invoice to it. This is how you get all your ITC back. Next, make sure your own sales invoices are perfect. And finally, don't miss those deadlines. File your GSTR-1 for sales and then your GSTR-3B to pay what you owe. You just do these things every month and you'll be in total control. You know, at the end of the day, getting your GST rate, it isn't just about avoiding trouble. It's about building a solid, professional, and sustainable online business. It's a sign that you're taking this seriously and you're building something that's meant to last, especially in the competitive world of e-commerce. So there you have it. We've laid out the entire map, from getting registered all the way to filing your returns. The map is officially in your hands now. So the real question is, what's the first part of your GST journey that you're going to focus on? Are you going to start by double-checking your invoices? Or maybe finally sit down and tackle that GSTR-2B reconciliation? Whatever it is, the most important thing is to just start today.